Welcome and thank you for tuning in. You're listening to the Beyond 50 radio program. I'm Daniel Davis. Today we're going to be talking about economics. A lot of people wonder just how the economy is going to improve and when that may happen. When you watch television or maybe pick up the newspaper or listen on the radio, you hear a lot of different opinions from economists that tell us, well, it looks like we're recovering, and some of them say, well, it may be a little sluggish and take a little bit longer than we thought. And there are others that say, well, things are okay just the way they are. On the program today, we're going to welcome back a guest we've had on the program before, and he's got a new book out called The Demographic Cliff. He says, hey, look, we're in this for the long haul, and things aren't going to be as great as a lot of people may think. And that is because he bases his forecasts on demographics, that is, the aging population of baby boomers. We're going to be given a lot of interesting insights today at how we can figure out that this is sort of a long-term thing that we can definitely belt down and say, well, what can we do about it? And B, take advantage of some of the things that will be happening as this occurs. I'd like to welcome to the Beyond 50 radio program today our guest, Harry S. Dent, Jr. Harry, how are you today?
Good, Daniel. Good to be back.
You bet. Now, this here is probably the single most thing that I've heard in the last couple of years that makes the most sense because you base it on demographics and the aging population. Give our audience some clarity about what we're talking about here.
Yeah, back in the late 80s, I discovered a new indicator for the economy. I call it the spending wave. People enter the workforce around age 20, give or take, and then they earn and spend more money and grow in productivity in the workforce, all great things for the economy, into about age 46. And so our economy has been booming from 1983 to 2007 on an almost exact 46-year lag to the birth index. Baby boomers grow up, stop becoming hippies and stop becoming expensive and in college, and they start producing, raising families, buying houses, borrowing money. And that's what's driven this boom. And, of course, the Federal Reserve has goosed it up a little bit beyond that. But, that's the cycle. New generations grow up, earn and spend more money. Every 40 years they peak, like 1929, 1968, 2007, and then they start saving for retirement when they don't have to spend money on the kids anymore. Mm-hmm. It's not that they have a worse lifestyle or their incomes go down that much. They just start saving instead of spending, and that's what's been happening since 2008, that the baby boom generation peaked in their spending cycle. We had this huge debt bubble, the greatest in history, this subprime lending bubble in housing and real estate, and now it's all been unraveling, and governments have just been saying, after the first crash, we won't let it happen. But you can't prevent something this big and this pervasive from turning down. So we think governments, after goosing up the economy for the last 5 years, are going to fail because there's a second sector demographically of our economy, which is huge. It's 20% of the population that spend and earn about 50% of the income, and they peak later in their early 50s, right around now, age 53 at 2014, and they're going to turn down like the average household did after 2007, and the government's not going to have anybody left to stimulate with all their endless money printing. And the markets that they have goosed up with all of this money that's gone into speculation, because it certainly hasn't gone into lending, and it certainly hasn't gone into stronger economic growth in the past, it's going to bust. And so our theme is very simple, Daniel. You get bubbles throughout history, and they only occur once in a lifetime, like the Roaring '20s and in the last 2 decades. Bubbles go to extremes, and then they burst. And when they burst, they don't correct, and there's no way to stop it at some point. They just crash. So you have to protect yourself from what I see as an inevitable crash in the next 2 to 6 years.
Mm-hmm. Now, one of the things that was really eye-opening for me is that you talk about how Japan is in what you would call the, I'm trying to remember the right word here, the coma economy. Describe what that is.
Well, here's the thing. I mean, this the recent book, The Demographic Cliff. What I've emphasized here is that we've talked about this baby boom generation peaking and smaller generations in most countries to follow. Well, Japan was the first to see this because their births peaked just after World War II. So they were way ahead of us on this peak in baby boom spending. And when their baby boom collapsed in the 90s, and we predicted this in 1988, 89, nobody else I know of predicted Japan would collapse to such a degree in the 90s, was because their baby boom dropped off in spending, their bubbles in real estate and their bubbles in stocks collapsed, and they've been in a coma economy ever since. Why a coma economy? Because they have been stimulating, like we have, printing money, trying to offset the losses in the banking sectors and to keep money going in the economy so you don't have a major collapse like we saw in the 1930s. This is like the 1930s, but governments are saying we won't let it happen. So Japan is the perfect example of, well, we're going to endlessly print money, and we're not going to let the banks fail. We're not going to let major companies fail. So the economy never gets to reset, wash out the excesses, wash out all the debt, force greater efficiency. So Japan has had a 80% decline in their stocks at worst, 60% in real estate. Nobody would have thought that was possible. We predicted that in the late 80s. But they can't recover even though they keep upping their stimulus because they're not letting the free market forces reset the economy so you can flush out this debt, flush out these excessive prices, and go on. But their bubbles have still burst. They just can't come out of this because they've never let the economy reset. So Japan's economy in the last 2+ decades has been zero growth on average, sometimes up, more down. Sometimes deflation, sometimes mild inflation, but more deflation. They've been pretty much at zero, which is like, to me, a coma economy. It's like a person in the emergency room being kept alive on a breathalyzer. I mean, they're just like being kept alive barely, but they're not coming out of it. And that's what you get when you don't let free market forces reset the economy, as they did in the 1930s when we had a Great Depression, we had a banking crisis, but we eliminated zillions of dollars of debt, and we forced efficiency in the economy, and we came roaring out of it and became the greatest country in history. We're not doing that now, and Japan's not doing that now, and they won't if we continue these policies.
I know that as I was reading The Demographic Cliff, that, to let the listeners know that it was a book that finally, to me, made a heck of a lot of sense about what's going on. And having done this show now for 10 years, I remember in the first couple of years I thought to myself, as we started, it had the idea of this is for the baby boomers. But instinctively I thought, I want to kind of get rid of that title and just stick with Beyond 50 because that is Generation X or the Echo Generation, Generation Y. As they begin to age, they're going to be facing the same sorts of choices. There really isn't going to be much of a difference between what a 40-year-old in Generation Y experiences and one that's in Generation X or one that's a baby boomer, for instance. You're going to be facing the same sorts of choices. You may think that you may be approaching them differently, but it really is the same thing. But the most important thing that really started emerging from this, for me anyway, as I was reading this, is this, and it was so clear, is that economics, if you will, was born from basically natural laws from mankind, if you will. And if you take a look at nature, especially when it comes to forests and so forth, and you see forest fires, what happens is they go in and they kind of clear out all the old brush and so forth, and it destroys all the trees and the plants that are sick and dying anyway. And what you have is tremendous resilience afterwards, as you like to talk about in the book, innovation. And I thought, why don't we allow this forest fire to happen instead of trying to prevent it? Because it's going to happen anyway. You just can't prevent something like this. And if you don't allow it to happen naturally, then it's probably going to be more devastating than you wanted it to be in the first place.
Yeah, no, exactly, and that's what Japan has proven, and that's what we're doing now in Europe. The whole what I criticize economists most for is not their intelligence. They're all intelligent. Mm-hmm. They're all highly educated. They never had sex or run a business. They don't understand the dynamics of the free market system that does go through these inflation and deflation cycles. And when we have the most inflation or the most deflation, that's when you get the greatest innovations. I've studied history for hundreds of years and beyond, and it's crystal clear. And those innovations in the bad times, like the 70s or the 30s, move into the economy in the good times and accelerate the already good trends from the rising generations where they're earning and spending more money and becoming more productive workers. It's a natural cycle. It does have its extremes. It does have its good and bad times. But if we don't allow, like you say, the best park rangers, when a forest fire happens, unless it gets out of control, they let it happen.
Right.
They know it's part of the natural process. They know that all of evolution has happened when certain species fail and other species, emerge. And we're insulated from that wisdom because the economy's been too good for so long. And we think, we can just always grow, get better, go to heaven and stay there. And that's not the way the real world works. So that's my criticism of economists. Mm-hmm. They don't understand the play of opposites that actually drives our standard of living in the free market system. And free market systems need democracy to offset them because it can get too, we can get too greedy and too many people can get in control. But what we've developed since the Industrial Revolution and the American Revolution in democracy has been the killer application for economics since the late 1700s. And now we're killing the golden goose by saying, no, things are down. We'll just let the government take over and keep the economy going in this comatose state because we don't want to go through a difficult period. You have to go through difficult periods to have progress. Individual people have to go through difficult challenges to grow. I mean, how would any of us grow if we didn't have setbacks and have to relook at who we are and what we do and why we're doing it? The economy's the same way.
Now, what I thought was really interesting, too, is when we talk about the aging population is that it's slightly different in the United States because we really don't have the attitude of, or let's say, laws or ideas about having children, like, for instance, in Japan and China. And, in fact, in Japan, as you were talking about in the book, that what you're seeing more of now is that the younger generations really aren't getting married. If they do, they're not having sex and having children because they're afraid of the fact that, that's kind of expensive to support a wife and a child.
Exactly.
And in China, they actually had laws where, from my understanding, is, you had to ask permission to have a child, and usually you could maybe have one. If you were lucky, you could have two. Now, you look at that groundswell. Now, a lot of people got all concerned about China, becoming this huge superpower, but when you think about it, based on that law, well, sure, they're swelling, and now you've got an older population that was very good, perhaps frugal about saving money. Now they have all this money. What do we do with it now? But as they go, there's really no younger generation to step up to. Tell people why that's important to understand something like that.
Yeah, I mean, China, because they had their one-child policy since the 70s, and because the government has way overexpanded their economy to keep jobs growing and to push people from rural to urban areas. Now, that's natural, but they've done it at 3 times the rate of any country in history. It's just off the charts. They have created the greatest bubble in history because they do have an aging population. Their workforce from age 15 to 64 has already peaked in 2012, is going to slowly decline for 10 years, and then it's going to drop off. The first emerging country to see that happening because other emerging countries had those higher birth rates to keep them going. But China has also overbuilt their economy, 27% vacant condos throughout cities, whole cities of 1 million with nobody in them, 40% excess capacity on average in their industrial. I mean, they have overbuilt everything beyond, for the next 10 to 15 years. And when the economy globally slows down and they have to deal with their real estate bubble unraveling, and it's the greatest in the world, I think China's going to be the greatest collapse in the next several years, and China's been the greatest growth engine. So even if the people say, well, the Federal Reserve will keep printing money and stuff, I'm like, okay, how much money can you print to offset the global impact of China basically imploding with the greatest real estate and overbuilding bubble in history? And my answer is you can't print enough money.
I know it was fascinating to read, just to put a number to that urbanization in China in just 12 years grew from 53% to 72%. And as you were saying, and it says right here in the book, that means that 250 million more people will be uprooted from their farms and moved into high-rises. Now, when you take a look at that kind of speculation, I think that people were seeing that here, especially in the 1990s into 2000. I remember looking around, and this was right around the time that we started the show, which was right around 2004. And I'm looking, and I started becoming alarmed because I was thinking, there sure are a heck of a lot of mortgage companies sprouting up. I mean, I was looking at this like, all of a sudden you're infested with them. There were more mortgage companies than there were supermarkets and restaurants, it seemed like. And then it was just, you're thinking, wow, this is incredible, but then it doesn't make sense. And instinctively for me, and I even had friends, we're about to buy this house over here, we're going to get a loan. And I'm thinking, yeah, well, you're the kind of guy that works at a place like McDonald's, and you're going to go and you're going to take on a mortgage like this. Well, we've got an adjustable arm, which means that, that my payments may go down. And I'm thinking, well, I've really never seen that happen before. And sure enough, by 2006, 2007, 2008, mortgage leasing buildings became dead zones and people were out on the street trying to find places to live. And I was just like, I wasn't an economist, I wasn't a mortgage broker, but you could just sense and see that there was something really wrong here.
No, there wasn't. The U.S. subprime crisis set off the whole last Great Recession in 2008 to 9. But you can't set off a global downturn unless the whole global economy wasn't so much in debt with so many derivatives and slowing demographics. I tell you, China is different. People say, oh, well, the Chinese don't borrow it, no money down. I'm saying that's not the problem there. The problem in China is that Chinese save 50 to 70% of their income based on affluence, and the most affluent save closer to 70%. And they put almost all their money in real estate. They are buying condos that are empty. Imagine in the United States, people buying condos in cities that are 20, 30, 40% empty, thinking they're going to keep going up. In China, they do that. They love real estate. They don't trust stocks. They have one of the most volatile stock markets in history. They don't trust their own government and stuff. They put their money in real estate thinking it can't go down. Well, that's what we thought in 2005 or 6 when we thought, the tech stock bubble burst and bubbles before that, but real estate will never go down because there's more people and less land. Well, that's not true when you look at it long term, and China is going to blow like nothing you've ever seen because the reason is not going to be massive defaults on loans at first. It's going to be the richest Chinese, the 10% that drive 60% of their consumer spending, are going to see their wealth start to evaporate. They're going to stop buying real estate in China and all the English-speaking cities around the world. That's going to cause bubbles to collapse in New York, London, San Francisco, L.A., Vancouver, Sydney, Melbourne, Singapore. And then they're going to stop spending and saying, oh, my gosh, we're not as rich as we thought we were. Their wealth has been exaggerated by this real estate boom. And it's just like the Japanese in the late 80s. Their bubble exaggerated their wealth. They were buying real estate around the world. Their industries were expanding at super low interest rates and competing with the U.S., and then suddenly the whole thing collapsed when the bubble collapsed. So that's what I'm seeing. China's going to be the biggest impact over the next several years, but we're also going to see Germany decline like Japan did in the 1990s, and we predicted that, and nobody else predicted it. Their demographics fall even steeper than the Japanese in the 1990s, and they're supposed to hold up the Eurozone and bail it out. They're not going to be able to do that. And the wealthiest people in the United States, who did not peak in 2007 like most of the population, they're going to fall off their demographic cliff. Automobile sales are going to fall off a cliff like home sales did many years ago, and we're going to see a much worse economy. I look at demographics. It's a way to look around the corner. I look at bubbles. They go to extremes, and then they burst, and everybody says in the bubble, oh, this is not a bubble because of this and that. Every bubble is a bubble when it goes exponential, and every bubble bursts. And the greatest single bubble I see in the world today is China real estate, off the charts.
Mm-hmm. And, that's a great model, especially for Americans, to get a really good understanding about what's kind of happening here. Now, to give more accuracy to this, the baby boom generation came from the greatest generation, so to speak, and that was a generation that was very frugal because of their experiences of the Great Depression. They saved money, they paid things on time, they weren't really so big about using credit, which began to be made easily available by the late 1970s, especially with credit cards. But you take a look at the fact that now as this baby boom generation ages, they were people that weren't like the greatest generation. They tend to spend money. They didn't really save as much. Then all of a sudden they're raising children, so it was really more difficult for them to save money to be able to do these things. But they still went about buying houses, and as you were talking about in the book, they'll buy their first home. It's pretty modest. They have children, so they move on to a bigger home. And as the children leave the house, and you actually give, age definitions, this was like in the 40s if I remember, then the children begin to leave the house, and so they begin to either scale down or they buy a vacation home. So that way they can have a home close to the grandchildren, and then they can get away, for a summer vacation, whatever the case is. But then it gets to a point where they get older and they either move into retirement homes or maybe they're able to stay in their home, however that really works out. And then that next generation comes up to move into these homes that are now becoming vacated by a very large population. The difference is because of how the economy has worked, it's allowed less and less people from these upcoming generations to be able to afford to do so. They're staying in apartments longer, they're renting longer just simply because they can't seem to earn or have the kind of earning power that the baby boomers had to be able to move into this. So now you have all this speculation, and this is why China, I thought, was a really great model for real estate and why you need to be careful, and it's not maybe the great investment you thought it was, is because their groundswell is now going to move away. And this upcoming generation just doesn't stand a chance because, as you've been saying, there's all this money printing that doesn't allow innovation and growth to be able to have these people have specialized skills to be able to earn the kind of income that can help them move in to the vacancies that are occurring. And so now you have all these empty buildings and houses, and there it is.
Yeah, well, even in the United States and in Japan and developed countries, the generation following the baby boom is smaller than the one before, and young people buy homes from 27 to 41, what we found in the peak home buying. But older people start to downsize in their 50s, if anything, and then when they die, they're sellers. Well, what happens in an economy like Japan, where there's more adult diaper sales than baby diaper sales? What happens when there's more older people selling homes because they're dying than young people buying? Real estate doesn't expand anymore, and home prices don't go up long-term like they've gone up in the last two generations. That is one of the biggest things I see coming up. Chapter 3 of our book is entitled, Real Estate Will Never Be the Same. Now, that's not in India or in emerging countries, but in developing countries, outside of a few small isolated countries like Australia or Switzerland or Sweden, real estate will never be the same. There will never be the demand outstripping supply we've seen since World War II. So people who are thinking, oh, real estate's crashing, but it'll come back. Well, it'll come back a little. Mm-hmm. It's not going to boom like it did in the 80s, 90s, and the early 2000s ever again in the United States, because there'll just not be a net demand for new housing because older people are dying as fast or faster than young people are buying. That's a huge reality.
Now, you also give a great suggestion that if somebody was kind of looking at real estate as an investment, the best way to do that is to take a look at getting in when at the price that the real estate was before or as the bubble began. Now, talk about that a little bit. That was really an interesting way to look at, I guess, speculation, for lack of a better word.
Well, it's also, Daniel, it's more important in real estate than stocks. Stock markets go up and down together when there's, booms and busts and international crises. Real estate's different. Real estate is very local and regional. And real estate, I say, is more like a popcorn popper, where different bubbles are peaking at different times and then crashing. But it's a real estate bubble around the world, and in the end, all these real estate bubbles will burst. So I tell people, look at what your real estate, residential or commercial, was worth in January of 2000. That's when the bubble really began and went exponential. And bubbles go back to where they started or a little bit lower. So if you have real estate that's close to those levels, January 2000, well, then you're probably okay. But if your real estate is still valued a lot more than that after this downturn, you're not okay. And I think there's going to be another big downturn in real estate. But that's the judge I use for real estate. What was it worth in January of 2000? Anywhere in the country.
Just such a fascinating way to look at all of this. But you also tell people that even though we're having these kind of busts, if you will, and that, this demographic cliff is occurring, that to give solutions about how people can begin to take advantage of what's happening here. And I couldn't help but think of, for instance, investor Warren Buffett. Wonderful book out there, I believe it was called The Snowball, in which a woman had did a biography on his life. And you take a look at how he experienced, the different decades that he did. And, when you read something like that, you take a look at your book, The Demographic Cliff, it seems that the two of you are coming to the same sorts of conclusions that, to me, if I listen to the news about the economy or I read about it, is these guys, what are you, in Never Land? And I even had the opportunity to talk with his former daughter-in-law, Mary Buffett, and she put out a book on the Buffett way and was talking about how at that moment when we were doing the interview, look, General Electric is now selling at $6 a share. Now, this is a big company that probably had a lot of growth, but now it's down there where you can actually afford to buy the stock, and it goes up and down just like that. And it's just fascinating to think that people have this attitude that things should always just continually need to be going up, and how you can support that kind of a dynamic.
Yeah, and Daniel, things do go up longer term. It's called evolution. It's called progress, whatever you want to call it. But it goes up exponentially, but also in cycles. Exponential up, exponential down. Mm-hmm. And I remember back in the late 90s, I was debating George Gilder, who was a technology expert, and I love this guy. He's a great long-term thinker. And he was saying, well, technology stocks can't go down because the progress is exponential, Moore's Law and all this stuff. And I'm like, George, wake the hell up. They go up, they get extremes, and they crash. And just after that, the technology stocks crashed. But now they're back up again, and then they'll go up sooner or later. But life is exponential growth, but with major cycles, and the smartest investors, like Warren Buffett, don't buy when things are near the top of a cycle and they're looking great, like Japan in 1989 or AOL in 1999. They buy when you have a good company that is going to survive long term, because they have a great position, but you buy when they're down and undervalued. That's the best way to get long-term returns. And you can buy overvalued stocks while they're going up. That's called momentum trading. But that is much more risky because that momentum can change in a second. I mean, in early 2000, when the tech bubble reversed, NASDAQ stocks went down 40% in just like 4 months or something before they rebounded and went down 80-some%. So, it's very tricky to play that momentum game. But buying great companies or great industries when they're down and nobody wants to touch them, that's why the Warren Buffetts of the world do the best.
Mm-hmm. Well, yeah, because they also take a look at long-term before they even think about investing in a company. And when you take a look at television and you might watch a program, let's say like a stock report, you watch a lot of these people get excited, and what they're actually doing more of than investing is they're trading. This price is bound to go up, so, grab this stuff now and then sell it later at a higher price. And I think to myself, but an investor looks long-term. They take the hits when they go low, and then they enjoy the growth when it becomes high, sort of a thing. And as you said, long-term, it does go up if it's a good, solid company, but it's also a company that's innovative. Take a look at Apple Computers, for instance. There was a lot of innovation in that company, so it made it worth investing in. But now the question is, since Steve Jobs is no longer in the picture, what will Apple really be like?
Well, Daniel, what I do, what we contribute, we're long-term investors too, but we contribute this cyclical view that, yes, the long-term is good. You invest for the long-term and the best companies, the best countries, the best demographics, all these things we talk about. But there is this huge cyclical factor. And we have seen the greatest boom in history from 1983 to 2007, which we predicted more than anybody in the late 80s when I came across my demographic factors in technological cycles. But there's a time when those cycles reverse for a while. They have to relax. They have to, work out all the excesses and the debt and the overvaluations. There are times when those things are going to go down. So I wouldn't just buy a good company and hold it forever. I'd buy a good company when it's undervalued or the stock market. And then when it gets overvalued, I would lighten up and wait for the next inevitable correction. There's always a correction. Anybody that thinks we can have a stock market or an economy that never has recessions again, never corrects, is a total idiot. I hate to say it. I hate to use that word. Total idiot. Never happened in all of evolution, all of human history, all of stock market. We have to grow in these ways. We have to accelerate. We have to collapse. We have to innovate again, bring those innovations into the mainstream again, and then we'll overdo it. Human nature is to overdo everything and then to underdo everything. It's the way we learn, so it's not a bad thing. But you do have to let it happen. And my biggest criticism of mainstream economists and Ben Bernanke and Janet Yellen and everybody else is they think you can turn the economy into a machine and just make it grow at 2 to 3% a year with 1 to 2% inflation forever and never have a recession. If you did do that, which you can't, if you could do that, you would never have innovation again. You would it takes the extremes of our economy to expose the good companies and the bad companies and to force new innovations. The greatest innovations, and the people who've studied innovation, scientists way back beyond our times, have shown that our greatest leaps in human evolution have not come gradually over time. They've come suddenly through new surges and innovations, and then they kind of grow after that more incrementally. That's the nature of the economy. And by not letting this great bubble with great innovations in information technologies and new business models, by not letting it settle out, by not letting this debt bubble restructure just like a Chapter 11 for a company, and not letting this financial bubble come back down to reality. I mean, how's the next generation ever going to afford a home again? What home prices have become. If we don't do that we will not grow again. And that's my point in Chapter 2 of the book, that yes, you can choose to not have a crisis, not face the debt and the music, but then you end up in a comatose economy. You're dead because you're not growing anymore. You're not allowing growth to come back. You're not going to come out of the winter season into summer and blossom again. And Japan never has 24 years later.
Yeah. You know, the last thing I'd like to touch on, because you hear a lot this day and age, especially for people who seem to be, either conspiracy theorists or these are people that couldn't manage, their income well in the first place, and that is the idea that the dollar is going down to zero value if it isn't there already, and they're taking a look at getting on to a whole new monetary system. You know, they tried with the euro, but we've seen what's happened in Europe. But talk about the realities of the value of the U.S. dollar, especially as a world currency.
What people don't understand is that we've created more debt in the last boom from 1983 to 2008 than any other country in the world. We've been the reserve currency, and this has revolved around the world. The dollar devalued 60%. It has now been trending up, and every time we have a crisis, it goes up more, 27% in late 2008. The dollar is the safe bet, not gold and silver, in the next crisis, because as we deflate all this debt, there's fewer dollars in the world and they become more valuable. That's a hard thing for people to understand, but we are crystal clear on that.
Now, it's interesting because when you think about this printing of the money, I couldn't help but think, and this is just my imagination working here, is that here we have, you know, this government that says, yes, let's print more money so we can keep these big banks in business and these big businesses in business. And I couldn't help but think of the idea that they're doing that so that these government people who are in office can actually continue to be in office, because the money that goes to these big banks and big businesses guarantee that they're going to go ahead and, you know, make these contributions to ensure that they stay in office. Is that a possibility there?
No, I
know it sounds silly, but
nobody wants this meltdown to happen
in
their administration. No central bank, no politician. So they're trying to keep the bubble going, but at some point it will collapse. And my best indicators, long-term and intermediate term, say this bubble's going to collapse between late 2014 and early 2020, especially by late 2016. So I think this is coming to an end. You cannot keep something going artificially forever. You can't keep somebody alive on a respirator forever. This is getting ready to go into the next stage, and that's why I'm saying people should be very, very cautious.
Well, Harry, it's been a great pleasure to have you back on the program again. Again, the book is The Demographic Cliff, and I know that you have a wonderful website with a fantastic newsletter that people can begin to really understand. You know, forget about the news for now, because, you know, it's one day it's great, one day it's bad, so you can't figure out. It's like what you were talking about in the book, the push me, pull you sort of a thing. You know, and actually take a look at this realistically and get a better understanding so that you can begin to see opportunities and, I guess, you know, for lack of a better analogy, become a better poker player. Get the best of your money while you have it into the pot, and then protect it when you don't.
But, you know, and Daniel, one of our newsletters daily, it's very good, Economy and Markets, is free. You just go to harrydent.com, put in your email address, and you get on our free newsletter.
Harry, again, thank you so much for joining us here on the Beyond 50 radio program today. It was a great read.
Okay. Thanks again, Daniel.
You bet. We want to thank you, the listeners out there. Get yourself a better handle on what's going on out there. The Demographic Cliff. Fantastic book to give you a better idea about what's going on in the world of economics and how you can not only prepare yourself but take better advantage of the things that are happening around you. I'm Daniel Davis. Thank you for tuning in. You've been listening to the Beyond 50 radio program, and remember, live your day past halfway.